Welcome, ladies and gentlemen, to Commodity TV here at PDAC 2024, and it's again Uranium time. We want to talk again to Scott Melby, who's the CEO of Uranium Royalty this time.
Great, thank you, Johan.
Scott, great to see you again.
Yep.
Well, we all know what the royalty business is, but you are the first mover with Uranium Royalty.
Yep.
How did it come to that?
So I'm a co-founder of the company, and back in about 2017, we looked out there and we saw the enormous success that companies like Franco-Nevada, Wheaton Precious, Sandstorm, Royal Gold had in base and precious metals. And we really just were amazed that there wasn't such a vehicle for the uranium industry. And there's probably good reason for that. Our industry wasn't growing. We were in a bear market. Mines were shut in. People weren't investing in new mines. And so it's natural that a capital provider model like royalty and streaming wasn't in existence. But now, having launched in 2019, taken on the NASDAQ 3 years ago, we're the perfect structure business model for the perfect commodity at the perfect point in the commodity cycle.
Yeah. Okay, so what is the entry point for you? Because the thing is, with uranium mines, they tend to take really, really long until they go in production.
Yeah.
So why does it make sense for you to say, okay, we buy today the royalty of a company, but maybe in 10 years they are in production?
Well, a good royalty company will have near-term, mid-term, and long-dated royalties. The long-dated royalties you can acquire quite cheaply because there's a long ways to cash flow. Nearer-term mines that can produce and cash flow in this cycle, they're the unicorns. As we mentioned with the UEC discussion, that's a very elite group of companies that can restart operations, be in production. But I can say that cohort of companies and those that are kind of advanced stage of startup and development, they do have significant capital needs. And, they have at their disposal debt, equity. But we want to come alongside and say, hey, take a look at royalty and streaming. We can be a competitive cost of capital that doesn't have the dilution of an equity raise. It doesn't have the high interest rates and the covenants like a debt facility. And it's a bit of an endorsement. If our company comes along and supports a project, it's uranium experts endorsing that project and expanding the capital markets reach and exposure for that company. So we have a really receptive audience for the concept. We're in discussions with 6 or 7 companies on either acquiring existing royalties or providing finance for new projects.
Wow, so that sounds like future growth.
Yeah, it is a growth platform. So we studied all the success factors of the leading royalty companies, and kind of exponential growth is critical. Mm-hmm. So if we have 20 royalties on 18 projects today, by this time next year, I want to have 25 royalties and 30 and really expand.
Yeah.
The model's very efficient. The overhead, the G&A to run a company like this is $5-6 million. We can double, triple in size with the staff that we have. The most important thing, in my opinion, that we engage in is due diligence. So we have an expert in ESG, health, safety, environment, to make sure that the mines we invest in don't cause any reputational risk to us or our investors. We have experts like Darcy Hirschhorn coming from Cameco Global Exploration, 20 years of experience there, to scrub the resources. Did they do the drilling with the right regimen and professionalism? Are the resources there? And then we have James Hatley, who was mine engineer at Cigar and MacArthur, who really looks at the mine plan. Can they do what they said they do? Is the permitting timeline realistic? And so that's really to make sure that we're finding counterparties that fit in our portfolio and then know what's the right price to pay for them.
Super. If you look at your portfolio, which one or which royalty do you think would materialize first, meaning delivering the revenue to you? And how does that work? Because I'm pretty sure you're not getting the yellow cake directly in the bag, right?
Actually, we are. The most advanced royalty we have is with MacArthur River, which is the world's richest, highest grade mine in northern Saskatchewan, operated by Cameco and Orano. In that instance, we get our royalty interest paid in physical uranium, book transferred to our account at Cameco's facility in Ontario. It's cash flowing at these prices around $1.2 million a year. It will go up as Cameco expects to increase production at MacArthur to 18 million, maybe 24, 25 million. That's great news for us. And the higher the uranium price goes, the better it is for us. So that's our most immediate. It's cash flowing now and delivering pounds as we speak. Cigar Lake is the companion royalty to that. It's a net profit interest, so it's a little more complex. There's still some expenses in the net profit calculation that need to be worked down. But within 2 to 3 years, that could be cash flowing somewhere in the $5 to $6 million annually, depending on how much it's producing and how much they're selling the output for. We have a royalty on Langer Heinrich in Namibia with Paladin. It's a fixed royalty, which with them resuming production recently, we'll start to see our first payments this year. And then Lance Peninsula is an ISR project in northeastern Wyoming that is in the process of ramping up late this year, early next. So it's exciting because when we launched in 2019, we were still a ways from the cash flowing stage of the company. So one thing that we did to really incentivize and reward the early shareholders was to buy physical uranium off the bottom of the market. So we did that at $20, $30, $40, $50 a pound. And now we hold 2.5 million pounds of uranium inventory at a cost basis
it's super
of
liquid.
under 60.
You can sell every day, right?
We can sell it. So as we 25, 50, $100 million royalty opportunities presented to us, we'll sell that material into the market, turn it to cash, and basically take pounds in the drum, turn it to cash that's appreciated dramatically, doubled in value since we bought it, and then replow that money essentially into the ground to produce more pounds. So
exactly, and to get a dividend from it.
Yeah.
Fantastic. So what is, let's say, for 2025, 2026, what do you expect with the business?
Yeah, so obviously the continued ramp up of our existing royalty portfolio, but really growth. And if we make accretive acquisitions like we intend to do, you'll see, the market cap grow, the value of the company grow through these accretive transactions. So look for feedback there. We're traveling to Africa, Australia. We're looking at U.S. mines, Canadian mines, and really eager to come alongside those more promising producers and developers.
Okay, super. Where do you see now, let's say, the benefit for your shareholders? Would that be like that you might pay a dividend, or would it be like more the share appreciation because the value is rising all the time?
So we're very much in an early stage growth phase. So, we're obviously raising money to invest in royalties to grow the portfolio. Eventually, when we become cash flow self-sufficient, we can fund our own development from the free cash flow from the other royalties. And then eventually you get to a stage where you can throw off dividends. And that's obviously the goal of any royalty company. But I think for the time being, we should really think on share price appreciation and growth of the portfolio.
Absolutely. Where do you see competition in the future? Because I think you're still the only ones, right?
We are the only ones, but if it's such a great idea, it won't be for long. So
somebody will copy.
Somebody will copy, or we'll have diversified royalty companies can come in and compete in our space. But I think given that we're all decades of uranium experience, we understand the risk-reward proposition that is uranium probably better than anyone. Sometimes that hurts us because we see where the warts are in a project and we can discount it appropriately. Other times we see value that an outsider to our industry might not see, and we might be able to pay more with that knowledge. But and we also have relationships that go back 40 years, like the Cigar Lake MacArthur River royalties were acquired from a 97-year-old gentleman in Albuquerque, New Mexico, who helped explore and discover the projects back in the 70s and 80s.
Amazing.
So that's the deep experience.
Absolutely. Super. Thank you very much for that. Looks really like a great model. I really have to dive again deep into it because I think it makes also sense if you think about diversification. Because when you have like 25, 30 royalties, if you invest into your company, you have the whole
it's pure play uranium, but it's diversified exposure. So when you invest in UEC, you're investing in UEC's ability to develop those mines in Texas, Wyoming, and in Saskatchewan. With URC, it's a global basket.
Exactly.
Both
Super.
great ways to invest in uranium.
Yeah, we should own both shares.
Yeah.
Very simple.
Absolutely.
Super. Scott, thank you very much. All the best. And we talk soon, I would say.
Thank you.
Everything looks great.
Yeah, good.
Thank you. Yeah, ladies and gentlemen, that was Scott Melby, the CEO of Uranium Royalty. Yeah, you heard it. Still 18 royalties here now, and maybe going up next year by next year to 25. Things look great. They are starting to materialize on that, and it's a great business. They can triple easily the capacity here, can do it with the same management team, and I think it's a fantastic investment in the uranium space, very conservative, without any direct mining risk, and this is exactly what you want to have. So make sure you get some. I will definitely do so. Thanks for watching us, and bye-bye from PDIC 2024.